All right. So here what I'm trying to do is I'm just, these problems you will have to solve. So I'm trying to quickly give you some kind of theoretical foundation to be able to solve these kind of problems as you encounter them in the project. So that's the part of the learning that we are in right now. Okay, so it may seem a little bit haphazard, but this is how we are trying, this is the structure that we are trying to follow. So this discussion, we already have a long discussion on this, but I've tried to put all of these into specific notes so that you can refer to them as you encounter the problem. So this is for DP7. Let's go to DP7 initially and have a look at it. So as you know that this decision problem, that for that we already had a discussion. You look at this cell box, this cell. We have a box in this cell. If we go to the calc file, under the calc file, we have a discussion which is on 19th itself. All right, so we have this discussion on position size, and then broadly what we discussed is this. I'll put the broad steps, logical steps here later on. But you already know this. You should understand this. That you go from investable capital, make an assumption about how much of that is going to be risk capital, and then you project the number of trades for the period, project the number of losers, then that gives you the number of losing trades, and divide the risk capital by the losing trade. That gives you the risk per trade. Then you look at any particular transaction that you're thinking about, all right? What is the entry price? What is the exit price with the loss? These two are more important in determining position size. And then you look at the projected loss per share. And then in order to remember, you're trying to solve this decision problem. How many shares can I buy or sell? All right. So this you decide by dividing the maximum risk per trade by the number of shares that you can, by the P&L per share. Okay. So in this case, you would do this and you would decide the number of shares. And of course, you have to also factor in the brokerage that you're going to lose. For the sake of discipline, you have to make sure you calculate the brokerage as well. So this is how you do it. You can set up an algebraic formula. We'll do that later. Right now, we don't have to go in time to go into the algebra of it. But you can actually do this algebraically. You can set it up so that you can write the formula so that it is automatically determined, right? Instead of doing trial and error. Okay, so this is the thing. And then we had a discussion on pyramiding, which is also in this, which I have pasted the notes here as well. Okay. So this you already know. We have already solved, we have already discussed how to solve this problem. So let's go into this. So the position size problem is solved. Now I'm going to spend more time now on discussing on the other important problem that you are going to face, which is, we had some brief discussions on this. I showed you how to set the stops, etc. But we will come back to this actually because it's easier to understand this once you have understood this. And we also had some discussion on the entry price. Okay, we had this discussion where we saw that entry price, and here also I've created a separate. No, this is not. So, yeah. So we had some discussions on this as you again to give you structure, for this entire, for all this learning that you're trying to achieve. That what are we discussing in DP5? We had, that is the question of where should you enter? Should you enter immediately? You get a bigger discussion, you have a more detailed discussion of the topic, which is relative to the current market price, where should you enter? Right now, here itself, or a more favorable price or less favorable price, we had the discussion. So you guys have to do the readings here, okay? Please do the readings here and try to understand at least the basic types of orders. Market orders, limit orders, stop orders, and stop limit orders. And then there's one more also, which is the market if touched orders. Try to understand these basic orders, and you should try and do some reading here, and we will also be getting into some of these trend definitions later on. But this is basically the discussion we had briefly on DP5, all right? So DP5, we had a bit of a discussion. Now I'm going to get into this DP4 because I think most of you will be struggling with DP4, and that is how do we decide how do we decide whether to buy or sell? I mean, whether we should have a buying bias or selling bias. All right. So I gave you some kind of introduction into that before, which is that we said that you look at, I think here somewhere, we looked at earlier we had a discussion about how to decide the time frame when Sachin was asking a question about, this project is very short term. So how do you decide, what time frame to follow? So we had given you two time frames, which is the one is 1 year and one is 3 months. Okay, which we said this is your discussion which we had. So this is what we said. Now here what we are doing, this discussion will come in. So now we are going into this discussion of this part. How do you determine this? Because most of you will be confused about this. So I'm going to go into a discussion of that, okay? This particular topic. We are going into the discussion of this particular topic. You already had a little bit of introduction to this, to what will be the solution to this in the kind of questions that we have discussed. That when we have looked at these kind of questions, all right, how do we decide the time frame? This is actually related to this problem. So anyway, let's start with this this DP4 problem. Okay, let's start with all right. So here, let's start. Let me just create a new document for this, or we can actually put it in the session notes, and then I will create a new document later on. We'll put it in the session notes for today. All right, so here, let's discuss this one then. What we are trying to do is, so this document will be on, right? Okay, so how do we solve this, all right? So let's try and understand now. For this, let's go to have a broad this understanding of this. Let's go into this particular, your calc file. In your calc file, you will find that there is a sheet called DP4, okay? There's a sheet called DP4. So let's go to that DP4 sheet and find out what's going on there, all right? Okay, now it's a little, I think it's a little hard to fit into one screen here, but we'll keep it this way so that you guys can, I don't want to make it smaller than this in terms of zoom, because then you may not be able to read what's on the screen. I'll just move through that. You can see clearly. I'll just give you a short view of, I mean, a very brief view of how the sheet is organized, all right, so that you can see the basic structure. So what we are saying is this DP4, the question of when you look at something, like here we are in the case, we are with the euro, but if we take, let's say, any of your tickers, take any of your tickers, let's look at a slightly different ticker today. This is again a little
FCX or FCX.
Yeah, we can just go for it. I was just getting bored with FCX, so I said let's kind of go for AES or something else. But anyway, FCX is here. Let's go to that. These guys are actually bouncing us into right. So what was I saying here? That I got a little bit lost. Oh yeah. So I was showing you the zoomed out view so that you can see the structure. So when we come to this problem of when we're looking at FCX and we want to decide whether to buy or sell, what should we do? How do we come to that decision? How do we come to that decision? Then Okay, this is SPX. So as you can see, the stock market is rallying quite dramatically. Okay, so FCX is here. Now, when we look at this, the question of whether to buy or sell, okay, this is the basic question that we have. That is, what should be our bias? Should we be looking to buy in this market, or should we be looking to sell? That's the basic decision problem we are thinking about right now. And the way to do that is that there are two approaches to this. So you can see here, this is the solution paradigm. You'll be able to see it later when you, I'll zoom in later on. But this is the basic, and there are two broad approaches, okay? One is what we call the value versus price approach, and one is the value agnostic approach. So these are the two splits, and then within this there are other splits. So this part is basically the TA part. This is technical analysis, all right? And this is the part of this on the left-hand side. This part is the FA part of it. There's other parts here also, which we come to. So now I'll just zoom in again so that you are able to see it and it's a little clearer in terms of the font size and all that. All right, so I'm just now going to this. So there are two approaches. How do you solve this? There are two philosophical approaches. Make sure you understand this part very well, because this will not be there in any book, but it's important for you to understand to help you to decide also as to the question of the other one that Utsav raised, which is that he was saying whether to use FA fundamentals or to use technicals. That also is a decision problem. He was correct, but that we treat as a sub-decision problem under the DP4, under the larger problem of to buy or to sell, because these questions only arise in the context of the decision problem of whether to buy or to sell, right? So let's try to understand the philosophical differences. One is what we are saying, one is value versus price comparison. Okay, so we'll just call it value versus price. And the other one is what we have called value agnostic. Okay, now agnostic only means agnostic is, let's just copy this here and try to explain things. All right. Okay, what is agnostic? Agnostic means you can look it up, but basically agnostic is a concept used in the context of religious people or atheistic people. Agnostic generally means, let's put it this way, don't know and don't care. Okay? Not interested really, not really bothered, right? So value agnostic means that not really bothered about value. So here it means hence not really concerned with value. Right? What do we mean? Okay. So remember that there is something called value and there's something called price. So let's also understand the difference between price and value. Okay. Price is okay, so since we have lost a little time, let me not waste more time on asking questions. Okay, so price is objective. You have to understand this basic difference. Price is objective and value is subjective. So you may very often find people in the market, when you're listening to commentary, people are saying that the value is subjective. Let me explain what is meant by this. All right. Price is objective in the sense, if you ask yourself the question that, where did FCX close last night in New York? What was the closing price? Now that is around 1446. Okay, well, it is 1446. You can see it here. Now here we say it's objective. Price is objective because you can't argue about this. This was the closing price in New York. So everybody has to have the same view on this. So it's objective reality. This is like asking, what time did the sun rise in Calcutta today? You can't have different opinions on that you have to look up the Met Office website and find out what time it rose. It rose, and that's the right time. Okay, so it's objective data. It's objective information. The price is always objective. It is what is available in the market. Okay. checked from the market. All right. So price is always objective. Value is subjective. Okay. Value exists in the mind or calculations of individual investors. All right. So here you may just make it bad English here to make everything fit in one line. Okay. Okay. So exists in the mind and calculations of individual investors. So which means that different investors. Why do we say it's subjective? Because different investors. Okay, different investors can have different.
Sir, because
Yeah.
the value of share in the mind of investors are different. Something on the basis of demand, something on the basis of market share. So, sir, the value depends on that.
Well, not exactly. Actually, what I mean by value is that, actually, when you say value, I'll explain briefly. I have to add one more word into that word value. Let me just finish writing this. So, different investors will generally the reason I write generally is because it need not always be true. Sometimes, by coincidence, some few investors might have the same valuation, will generally have different value estimates for a given asset. All right. So here value means, when we say value, we have to always understand that it means what we call, you have to get familiar with this one technical term. It's fair value. Okay, the technical term is actually fair value. Let me just make everything 14 so that. So here value means what we call fair value. This is a term that you have to get used to now. It's a technical term. Okay. Fair value, this is a technical term in finance. So when we talk about the two arms of the DP4 solution paradigm, when we have the two arms of the solution paradigm, one is value versus price and one is value agnostic. Value versus price here, for this value, I'm just trying to explain this term value here. Value means essentially, this term value here actually stands for fair value. All right, so shorthand for fair value. Putting it here. Value means fair value. What is fair value? Fair value means that when you look at this any asset price, okay, you look at this FCX chart, and what you do is you are already familiar with what you guys have done. You have already done these exercises, except that you are not probably told that you are doing a fair value analysis. So all these things which you have done in the past, when you did the value of a project NPV, when you calculated the NPV of a project, when you used your Gordon growth model to calculate the fair value using the dividend discount model, the Gordon growth model, to calculate the fair value of the stock, to calculate the value of a stock. Now, you probably were not explicitly aware of the difference between the stock value and the price, but what you were actually calculating is the fair value. Okay, when you do the bonds analysis for the bonds, everything is these are all fair value analysis, basically saying essentially that, you know, here value means fair value, which is asking the question, what is the asset actually worth? And as opposed, of course, you can always say that it is worth what the market says it is worth. But that's not what we are asking when we are talking about fair value. Okay, we are actually looking down on the market. We are disregarding the market price, and we are asking value means fair value. When we talk about fair value, we are actually disregarding the market price. We're saying the market doesn't know anything. Let me find out what this asset is actually worth as opposed to the market price, because you can always look at the market price and say that this is worth, like in the case of FCX, you can say that this asset is worth 14.46 because this is what the market is pricing it at. But that's not what we are discussing when we are talking about fair value. We are talking about doing our own calculations to figure out how much FCX is actually worth. What should be the actual fair assessment of the value per share of FCX? That's what we are doing when we do this fair value analysis, okay? And so just to make you understand it a little easier to understand, you have already done this, okay? When you did all this, your project cash flow discounting, when you did all this project cash flow discounting, what were you doing? You were all doing fair value analysis, okay? Stocks, Gordon growth model, because if you wanted to know the price of the stock, you could have just checked it in the market, but that's not what you were doing. You were projecting the dividends into the future and then discounting the future dividends and then arriving at what is called a fair value for the stock. So understand this new term called fair value. So fair value is directly opposed to the market price. Okay? So fair value is directly opposed to the market price because fair value says basically that the market doesn't know anything. Let me find out what this asset is actually worth. And the general framework for doing that is you project, as you see here, the same thing you'll be able to see the commonality between the methods that you used, okay? In the case of bonds, stocks, you have done all these three: project valuation, stock valuation, and bond valuation. You have done all these three. And if you think about it, you may not have thought about it when you did them, but if you think about it, the structure was always the same. The structure was always that you would project the cash flows, okay? Your period 1, period 2, period 3, etc. You would discount the cash flows using the discount rates for the particular periods, and then you would add the present values of all the different cash flows, and then you would get your and then you deduct the cost of the project and get your NPV. But mainly the fair value of the project, you would just discount. You would add up the so let's talk about this brief fair value estimate here. I think I had a discussion. Okay, we have only one. I'm going to write it down here. So just that you understand the commonality between this, right? Which is that if we go to the end here, so let's call this a general asset valuation formula, okay? What is the general asset valuation formula or logic? Okay, you are already familiar with this, and this applies to therefore project, not fully the NPV, but when I write NPV here, I'm leaving out the, as far as the general formula is concerned, we forget about the cost of the project. Of course, for the NPV, you have to factor in the cost of the project also. But I'm talking about the part of the NPV calculation that is leaving out the cost of the project. So the actual cash flow values of the project. That's what I'm talking about. Project NPV, stock valuation, okay, through the via Gordon growth model, etc. Right, all this that you've done. Bond valuation, okay, which you have done through YTM, okay, etc. So YTM is the yield on the project, but in that there is the value, the fair value of the project is also included. So all these things, what you're doing actually here is try to understand that you have used a general asset valuation formula or logic, which means, and here's how it goes, okay? For any asset, okay, now you should be able to see the commonality between these, that these are all, they are not different. They're all the same structure, the same framework applied to different assets. So what is the same framework for any asset? Project future returns from asset. Okay, that is step one. For any asset, let's go for stepwise. Okay. Project future returns from asset. Okay. Then determine discount rates and factors. Okay. So discount factor basically means, so if it is 1 by, if R is the discount rate for that period, okay, if R is the discount rate that you're using for that period, then the discount factor is just nothing but 1 divided by R, okay, to the power of whatever that period is. Okay, if it's n period, then to the power of n, etc. So that's a determine the discount rates and discount factors, okay, for all periods. The basic structure, you're already familiar with this. Then discount period wise returns. Remember, I don't say cash flows. I don't like to say cash flows because sometimes you may be discounting earnings, which are different from cash flows. All right. So therefore, I use a general term called returns. Now, returns is general, so even cash flows are returns, and so are earnings. So that's why discount period wise returns. All right. And then you add the PV, right? Add the present values of all period returns, and that's okay. So that gives you basically, and this gives you, once you add the present values of all this, you get the fair value. Okay, so FP here is fair value of, just not writing proper English here, fair value of the asset. Okay, has everybody understood this point? You're already familiar with this, you've already done this. Okay, so the only thing that you've done in the case of NPV, obviously, that once you get this, this is just the fair value of the asset. That is the fair, you take each return in each period, project the returns. Remember, this is a projection. So it's a forecast. And there's no guarantee this will happen. Generally, most of the time, we're making actual uncertain forecasts. So this may not turn out, but based on your projections, and then you discount the period-wise returns, and then you add up the present values of all the period returns. This gives you the future value of the asset, the fair value of the asset. And then from here, you deduct the cost of the project to see, I'm talking only about the project part here, to see the net present value. Okay. So this, in this case, in the case of GGM, when you're applying stock valuation, you don't have any concept of deducting the stock value of the cost of the project, etc. So this is the calculation, right? So has everybody understood this point? Everyone is clear about this? We can assume that. Okay. If you have any questions, just interrupt because I'm looking at another page, so I may not be able to see the hands being raised. Okay, so this is important to understand that, so that you're going back now and putting some context into some of the material you've already learned earlier, which is all the stock valuation, bond valuation project, and you're able to see that there's following a basic general framework. All right. So there's a basic general framework that it is following, and from your NPV, if you strip out the cost of the project, you are left with the fair value of the asset. That CO that you deduct, which is the minus sign, that is the cost of the project in the first year. That if you leave out, the rest of the equation is actually in the NPV, is actually the fair value of the asset. Now, this is what is meant by fair value, which is basically the answer to this question is answer to the question of fair value is essentially the question is the answer to the question of what is the asset actually worth as opposed to what the market price is. Okay, what is it actually worth? And the general formula is basically that the asset is worth what it can earn, right? And then we have to adjust for time value of money. So we apply this general formula. So this is important to understand. It's a little basic, but I'm going through it once again just to make sure that everybody has understood. So this is basically what you have here on this side. And let's try to understand what the thinking is, okay? Why do you do the fair value? Okay, why do you do the fair value? Because there is this paradigm, this side is called value versus price, comparison based analysis. Remember, this entire discussion is happening. When you did your entire discussion of all this bonds, stocks, project, I'll show you all this later on, but we can take it as a given right now because we don't have that much time. But actually, these things are all these are all calculations which are meant to help you solve the question of the whether to buy or sell, right? Whether to buy or sell. So this I can maybe try to put this here. Right. This is the basic question. So why are you doing a project NPV? Actually, the reason you're doing a project NPV is not because you're interested in project NPV per se as an end in itself, but because you need to decide whether to accept the project or reject the project. Okay, there's a proposal on your desk. You're working in the corporate finance office, the head office, and one of the divisions has sent many divisions have sent their project proposals, and everybody wants money for their project. Now, which project are you going to finance and which are you not going to finance? So as a CFO. So for that, you do the NPV. But this finance and not finance is actually a question of whether to buy or sell. So I'll show you later why accepting the project is the same as buying the project. And rejecting the project is the same as selling the project. Okay, it's the same thing. I'll explain to you later on. But this is where we are on this. This is basically the framework. So let's try to understand what is the price versus fair value framework. Price versus fair value framework. Okay. Let's try to understand this. So, you might have noticed that in a lot of finance textbooks, like Damodaran has a whole book on this. He's known as an expert on valuation. So there's lots of discussion in finance on valuation. But what we are learning here as a new thing is, why do we even bother with valuation? All right. And the other thing that you're learning is, well, why do we even bother with valuation? Because I'm not really concerned with valuation. I'm only concerned with these things. As an investor, okay, we are only concerned with these things. We are only concerned with decision problems. I don't really care about valuation. Why do I care about valuation? Because the question of valuation can become important while I'm trying to solve this problem. That what should be my buy-sell bias? Should I be a buyer? Should I be a seller in the stock? Okay, that is where the context. So I'm here putting some context on your valuation discussion. So you have a lot of chapters written worldwide on valuation, but in most of the cases, they are not explicitly making the connection between the valuation as a means of solving this decision problem, whether to buy or sell. Because strictly speaking, we are only concerned with decision problems. We're not concerned with valuation per se. But in this branch of the tree, valuation becomes important, all right? And which is because we are in the value versus price branch. And so we are trying to understand what is this fair value and how does this framework work. So once we calculate the fair value, okay, so this, we're talking about value agnostic. Price versus value distinction. So here, let me put this here actually. I want to just put this here, this part. That now we are discussing this part, right? we are going into this, trying to understand what the philosophy is on this side of the tree, of this side of the tree here. Okay, what is going on here? So we have we understood how to calculate what is the general method for calculating fair value. We understood that, right? And now let's see how it is used to compare with price, and how do we help? How does that help us to make a decision regarding buy sell? So here I'm writing it as buy sell, but please understand it as buy sell bias. Okay, as we explained earlier. Why does it have to be biased? Because we are not yet solving. Okay, so when we say buy sell, please understand it as buy sell bias. We're not talking about immediately buy sell, because if we just meant immediately buy sell, that would mean that the next one, which is the DP5, we are always solving by using market orders, which is not strictly speaking the case. So therefore we write it as bias. All right, so buy sell bias, but I'm just going to just say, in order to avoid saying bias, I'll just say buy sell. Right? So what are we doing here? Let's yeah. So what is happening in this value versus price? How do we use it to solve the buy sell problem? So let's, yeah, we are having this discussion here. We have figured out how to calculate the fair value of any asset. Generic asset valuation formula logic. All right. For let me make this little clarification here, because on this side of the tree, as you notice, under value versus price, there are actually two approaches: AFV and FBV. Okay, so we are going to discuss this a little later. This is AFV, stands for arbitrage free valuation. We'll forget about this for now temporarily, but you should be aware that there's another approach to doing it. But what you are already familiar with, FBV, right? So which can broadly be called, this is where your fundamental analysis is. Okay, generally when you're talking about doing, yeah. Yes. Somebody is saying something. Okay, so yeah, so try to keep yourself on mute unless you're actually asking a question. Okay, so all right. So what we are saying is this FPV stands for forecast-based valuation. So I'm going to make a clarification. The general asset valuation formula logic that I've given you, that we just discussed, this applies only to this part of the tree, not this part. Okay, it only applies to this part. So that's what I'm clarifying. So that's why I need to put this part here, which is when I say general asset valuation formula, we have to put this clarification for FPV, FA, or what is called FPV, or we are going to call this forecast-based valuation. That's why I'm calling it FPV, forecast-based valuation. Right? Or FA, I'm just going to write it once. I'm not going to explain it every time, but when we say FA, we are talking about fundamental analysis. We'll explain further what that means. But this framework that we have applied, this is only for this part. This is not, why am I writing this qualification? Because this general asset valuation formula applies only for this kind of approach to valuation. It does not apply to this side of the tree. We will discuss AFV later on, but this applies only to this. But still, it's important to have a general formula, because you're able to see that everything you did, your bond valuation, stock valuation, project valuation, all of these, they are not different. They are actually the same. They are fundamentally the same. We'll have more discussion on this later once, but they're actually the same. You should have some idea of it now. So what do you do? How do you use this? And we are saying that this approach is actually only relevant for solving your decision problem of whether to buy or to sell. Okay. So how is it used to solve the buy-sell decision problem? That's what we are going to see. How does this framework work? Value versus price. That's what we are going to see here, which is, let's look at it here. So this is how we use it. Okay. Uh, okay. How do we apply it? First, we calculate fair value. Okay. Let me. I'll change the colors later on. Have I used the term fair value here? Yeah. So here I'm just going to write FV, calculate the fair value. All right. This is the first step. You calculate the fair value using these methods, the same basic structure. So calculate fair value using the basic general asset valuation formula given above. Follow these steps and calculate the fair value. You can do this for any asset. All right. We had a discussion with one of your senior batches. At that time, there was a earnings release. There was actually a news release on HCL Technologies, and they had bought a bunch of licenses. They had bought a bunch of software licenses from IBM. You might remember this news. This is, I think, for your immediate senior batch. They bought a bunch of software licenses from IBM. Now, and then the stock price of HCL Technologies, when that news hit the market, the stock price declined. So the question that I was asking the students was, what does this mean from a valuation perspective? Okay, so here you can even use in that analysis, in that discussion, we went into the calculation of the fair value of those licenses. So even intellectual property, that is intangible assets, even intangible assets you can value like this, because the software licenses that HCL Tech has bought from IBM, they are not going to just sit there. They are going to be selling those licenses to customers, and the customers will keep paying some money for it. So those licenses are like any other asset. They will be earning some returns. And the way you calculate the fair value of software licenses is the same method. Okay, so if I give you a blank problem out of the blue, you can always see if you can fit it into this framework. Is this can I do this? Can I project the future returns? The value of any asset is basically what it's going to earn. Okay, so we can say the value of any asset should be based mainly on what it can earn, right, for the investor or buyer. So that is the basic idea, the basic principle, and that's what you use. So you can therefore apply this calculation, this framework that we have discussed here. We can apply it with any situation, and I gave you the example. That's why I've written any asset over here. It means it can be applied even to things like software licenses or any other kind of asset. Okay, so how do we apply this framework to solve this problem? Let's come to that. So calculate the fair value. First step is calculate the fair value. Compare fair value to market price. And market price we can write like this, right? Then three will be 3 point. Is fair value higher, lower than? So this may seem a little basic, but I'm just writing everything down so that, you know, because these concepts are new, I think, for most of you. And so that you can study when you're studying later, you have all the steps and nothing is left out. So then you ask yourself the question, very easy to do. Calculate fair value. This is a subjective process, okay? This is a subjective process, so let me also write down. I hope everybody understands now the difference between subjective and objective. This part is subjective, obviously, because why is it subjective? Understand that also, all right? When you're projecting future returns, let's say we are evaluating those software licenses. Okay, I give you the names of the licenses, but I give this assignment to the class saying that why don't you guys figure out based on the licenses, why don't you figure out the fair value of these licenses? Now, because each person, each student may come up with a different set of future returns. So Aman will have one set of future returns. Nikita will have a different set of future returns. Sachin will have a different set of future returns, because they're all, nobody actually knows what's going to happen in the future. So everybody's return projections are they depend on their assessment of, you know, how the future is going to look in that particular sector. So that's why we say so, and this is where the subjectivity derives from in your valuation estimates, okay? This fair value that you come out with, this is also subjective, because mainly it derived from this subjectivity, okay? Of course, there's also the discount rates. These are also going to be different between different people, but generally the discount rates don't differ that much. The differences here are not that much. The difference really comes from the differences in the future returns. These projections, these are very different for different people, and that's why mainly you get different fair values, right? So you do this. So this is a subjective process. So this obviously is not subjective. This is objective, okay? Because all you're doing is, suppose your fair value is 25 and the market price is 35. So you are just looking at what is 25 and what is 35. So there's nothing subjective about this, okay? And so then you ask yourself, this is also an objective process, okay? That, okay, this is also very easy to see. Everybody will have the same answer. Okay, now what we do is, instead of writing, so we say if FB, I'm just going to write it down. All right, let's see now. Let's see if we ask somebody now just to see. Now we are coming for the last part of this thing. Let's ask Harsh. So if I do this calculation, if I find, let's say, calculate fair value, this is an example, okay? And then in my example, let's say I'm doing the analysis for FCX. FCX market price we know is 1446. Suppose I do my subjective fair value analysis and I find that the fair value of FCX is actually $20. So after doing all this analysis, projecting the future returns, determining discount rate, discounting the future returns, adding up the present value of all the future returns, I arrive at the fair value of the stock of FCX. And I find that the fair value is actually 20, okay? So let's say fair value is $20. Just giving the example of FCX. Okay, if fair value is $20, yeah. So if say fair value is $20, then market price is, let's say, in this case, market, and this is just an example, okay? I'm just giving an example. In this case, market price is, we know what the market price is, 1446, right? We'll just make it $14, just for the sake of calculation, understanding, okay? So obviously it's fair value now. Now what we are saying is fair value higher, lower than market? If fair value is higher than market price, what should we do? Remember, this whole discussion is relevant only because we are trying to solve the buy-sell decision problem. Otherwise, we don't care about all this. Okay, and even in the TA setting, we'll see that we don't care about it even under buy-sell decision problems. But right now we are talking about how this kind of valuation, which you're already familiar with, how is it useful in solving the buy-sell decision problem? Okay, and this is how we do it. All right. So we have calculated fair value, we compared, and now we say if fair value is higher than market price, and if fair value, we have two scenarios. If fair value is lower than market price, all right. Okay, so now let's go back to Harsh. If fair value is higher than market price, should I buy or sell?
Buy.
If fair value is higher than market price, I should buy. Okay.
Yes, sir.
Harsh is saying market price is here, $14. Fair value calculation is $20, and Harsh is saying we should buy. And what is the logic for that, Harsh?
Sir, after some time, the value will go to fair value, which is $20, and we will gain $6 in the deal.
Okay, now you have to watch how you're speaking. You said value will go to fair value. You want to say that?
Sir, the price, sir, the market value will go to $20.
Yeah. So
At that time, we will sell and we will gain $6.
I understood what you're saying, but
Yes, sir.
caution against generally don't use as a side point. Okay, market value. This is actually not correct. Okay, market value. It is better to say price. Okay, so when it comes to the market, this is not a wrong statement. Market value is not a wrong statement. People do it all the time. But I would suggest, because we always want to maintain a distinction between value, which is always subjective, okay, and a price, which is always objective. So generally, always, instead of saying market value, say price, okay, just for your lingo. Of course, sometimes we may say, what is the market value of something? This is a completely correct term which he has used, okay. But we may say, like, if I have 100 ounces of gold, and gold is worth $100 per ounce, then I can say the market value of that gold is, 100 ounces into the $100 per price per ounce. Okay, so that market value statement is completely correct. But I would say in this discussion, always use the word price and contrast it with value or fair value. All right. So Harsh is correct, as you can see. So you have understood now. You understand from the answer given by Harsh. You also understand one of the underlying assumptions of this approach. When you're doing this approach, there are some underlying assumptions, okay? And one of the underlying assumptions is basically this, that eventually there is an assumption that the market price is going to move towards the fair value, okay? Now this is according to me, quite an aggressive assumption, okay? But of course, most people make that assumption. But you have to understand that this is an assumption. This is not very different from me saying that I am going to live till the age of 95. Now, it may happen or it may not happen. It's just an assumption, okay? So there's no guarantee that this is going to happen. So understand the assumption implicit in this approach, that you're assuming that the market price will move to fair value. It may not happen. And before it moves to fair value, it may actually... So Harsh is looking at the difference. His fair value is $20 and market price is $14. Yeah, let's buy it. But after that, the price may fall. It may start falling. It may go to $10, $8, $6. So there's no guarantee that it's going to go up to a fair value estimate. Okay, this is just your estimate. It has no real meaning actually, okay, other than for the purpose of taking your decision. It has no profound and timeless and objective meaning. Okay. So understand this problem, all right? So let's write down the framework. If fair value is higher than market price, we should buy. Okay. Now I understand your time is up. We have lost, or it's not yet fully up. It's a 1 minute left. Let's buy. Let me finish this discussion. If fair value is lower than market price, we should sell, all right? So if fair value is lower than market price, we should sell. Fair value higher than market price, we should buy. I'm not asking this question for the second part because it's pretty obvious. And in this case, you can, in this project, you can do both, all right? You don't have to even, in fact, you can look up the IB. I'll give you the link later on. There's a discussion on short selling. So you can actually, you don't have to own something in order to sell it. If you're bearish on something, you can directly sell it. You don't have to own something. You can actually do short selling, okay, which is, I'm going to use this term, short selling. You may have heard this term. Short selling is a technical term, okay, which is basically you sell something you don't own. And how do you do it? By borrowing the asset. I'm using the general term asset. In this particular project, you're dealing with stocks. So you're talking about borrowing the share, okay, borrowing the stock. All right, so that's why you see that, so I'm 1 minute over. If you go back to the screener, you will see that one of the criteria that I used was optionable and shortable. So all stocks cannot be shorted. There needs to be enough stock available for borrowing in order to short it. So short selling is basically selling that which you don't own by borrowing the asset. Okay, so I'm not going to eat into your lunch. I'm very sorry about the delay today. I think we lost about almost 20 minutes or something like that. We'll figure out a way to make that up through some other makeup session later on. Okay, but I'll release you guys now. I think you can go now. And yeah, so anybody has a question, they can stay back. The rest of the class can leave, because I don't want to hold up your lunch. Yeah, anybody has any question?
Yes, sir. Sir, I have one question, sir.
Yes, Sachin.
Sir Harsh. Sir Harsh. Sir, how can we sell? Sir, how can we sell anything if we don't own it?
Okay, as I said, if I might have made this statement earlier once in finance, that in general in finance we assume, okay, in general in finance we assume that we borrow, invest, okay. So when we buy something, we borrow and buy it, okay. When we sell something, okay, we borrow and buy, okay. We sell and invest, okay. This is not well written. We borrow and buy, we sell and invest. So basically the idea is, if in general in finance, we are going to assume that if we are going to buy something, we are going to borrow money and buy it. So we focus on the borrowing costs or the financing costs.
Yes,
And if I'm selling something, I always assume that I will take the sale proceeds and I will invest it. Okay, so similarly on the sell side, in finance, we assume that if we are selling something, we can borrow and sell the asset. So the way it works in the stock market is that there are certain stocks. Okay, that's why you notice that in your, if you go back to this, go back to your master list, and I think you look at the, what I put a bunch of tickers here. Okay, here. So if you look at the stock screen, this particular stock screen that I gave you,
yes, sir.
yeah, in that you'll see that I used the option short, which means here, look at one of the criteria that I had, optionable and shortable. Okay, so I've only given you those stocks which are shortable because there's enough stock available for borrowing. To answer Harsh's question, the way you sell something which you don't own, you can see the tutorial. It's there on the Interactive Brokers website. I'll share it with you guys. There's some short selling where you borrow the shares. So if I want to short sell FCX, I will borrow the shares of it, because when I sell it, I have to deliver it. Okay, within,
Yes,
within 2 days or 3 days, I will have to deliver the stock. So if I sell FCX at $14, let's say, then I will have to deliver 100 shares of FCX and I will receive $14. So that will be the exchange after 2 days on a spot delivery basis. But where will I get shares of FCX? Because I don't have them. So I'm going to borrow it from the market from somebody else who has the shares. And I'm going to borrow it, and then I will deliver the shares by borrowing the shares. And then later on, when ideally if it works out for me, then I will, after I sell it, the market drops, maybe it goes to $10. Then I buy back the shares, And so when I buy back the shares, I have to pay $10 per share, but I will receive the 100 shares. So those
Yes.
100 shares which I use, which I receive, I use those 100 shares to pay back the loan of 100 shares which I took over here. Okay, so I
Yes, sir.
pay back the stock loan. So that's how it works. Okay, this is basically the structure that we
Okay.
have for any kind of, and it's the same in bonds, by the way. You know, you guys know about the repo rate. You know about the repo.
Yes, sir. Yes, sir.
Bond repo is also is actually a way of borrowing the bond. Okay, so,
Okay.
for the person who is doing the reverse repo side, okay, we'll have the discussion on repo and reverse repo later, but I can mention it here. Okay, that example, bond repo is actually a way of borrowing uh, the bond. Okay, and
Yes, sir.
borrowing the bond. So bond repo you can look at it in two ways. Bond repo, as you know, is repo for one party and reverse repo for the other side. Same
Yes,
thing.
sir.
Like when I'm selling you my house, I am the seller. Okay,
I am sir.
I am the seller and you are the buyer. Okay,
Yes, sir.
same transaction, there is a seller and a buyer. So then similarly in a repo, there's one guy doing a repo and the other guy is doing a reverse repo. Okay,
Yes, sir.
so is a way of borrowing the bond. Also, it is a way of uh, financing, borrowing the bond and borrowing money using financing using bond as uh, collateral. Collateral is security. Okay, when you take a housing loan, you take a
Yes,
mortgage,
sir.
the house is the collateral. All right. So
Yes.
this is how you this is how you sell. This is how you sell that which you do not own. You borrow it and you sell it. Okay.
Yes.
Later on, when you square your short position, you receive the asset and you use that asset to settle your borrowing of that asset. Okay, like the example I gave you on FCX.
Yes, sir.
Right. So
Yes.
as a general paper, we should remember this. That 1 minute. There's somebody in the chat. Uh, okay. No, that's okay. Srishti is no, the class is actually already over, Srishti. So unless you're interested in the discussion that is going on, you can actually leave. I don't want to hold up your lunch. Okay. All right. So this is basically it. Okay. This is the basic structure that you can borrow something and then sell it even if you don't own it, and you can apply.
Okay.
This applies to everything. It applies to stock,
Bond.
it applies to bonds, it applies to currencies, it applies to commodities.
Yes, sir.
Okay, so general principle.
Okay.
Any so Harsh, your question is answered.
Yes, sir. Yes, sir. Yeah.
uh, Anybody else, any other questions?
No, sir.
Sir, sir, I have one small question, sir.
Yeah.
Sir, if I want to, sir, buy any stock, sir, if I want to buy Amazon stock,
Yeah.
so, sir, the who is selling me the stock, sir, can you put one condition that I will deliver the stock after 2 days, and can you also specify the range that the share price is now $15, and after 2 days if the share is of $17, then I'll sell you at $17, and if the price after 2 days if it decreases to $10, then I will sell it to you at $10. Sir, can you put some condition?
Okay, so the second part you mentioned is, so what you're saying is you're talking about a sale contract where you agree to sell the quantity, but you
Yes, sir.
fix the price as such. You don't fix a specific price. You say
Yes, sir.
it will be at the market price, whatever the market price is on that day.
Yes, sir.
That's what you're saying. Yes,
Yes, sir.
you can do that. It is not the standard type of market contract. Okay.
Yes, sir.
It's not a standard contract, but you can always come up with this kind of contract. There's no harm. There's no bar on it.
And sir, my main question is that, sir, if after 2 days, sir, he has fixed that if current price is 15 and he fixed that price is 20. If it goes to 20, then you will have to take at $20.
Yeah.
And sir, if after 2 days the price goes to $30, sir, then what will happen, sir, in that case?
So this depends on your, as we are already talking about a non-standard contract. Okay.
Yes, sir.
Let's first be clear about the standard contract. Okay.
Yes, sir.
Standard contract is that this 33.46, let's say the market price is 33.46. So if we do a transaction today, the standard contract is I am
33.46.
from you at 33.46. That means after 2 days, I will pay you this amount per share, and you
Yes,
have to give me 100 shares. Okay.
Yes, sir.
Now, after 2 days, the price of Amazon may have come to 2,400 also. It doesn't matter.
Yes, sir.
I still have to pay you at this rate.
Okay, sir.
All right, that's a standard contract. Now you're talking about a different contract where you are saying the price is not fixed. The quantity
Yes.
is fixed, but the price is not fixed.
Yes, sir.
You're saying that price will be fixed after 2 days, whatever is the market price.
Yes, sir.
So in that case, whatever is the market price on that day, that will be the price of the contract, because that's what you have decided in your contract terms, right?
Yes, sir.
So actually, I'm a little bit confused about your question.
And my question was that if the other person has fixed the upper limit of the share price, so like in this case, if he has fixed that I will sell, if the price goes to $4,000, then I'll sell you at that limit. And on the contract date, the price has gone even above the $4,000.
Yeah, then again, see, you're always, remember, contract terms, you have to fulfill all the contract terms. Okay.
Okay, sir.
So if the contract term says that we will buy at the, the transaction will be at the market price, which is prevailing after 3 days.
Okay, sir.
Provided that if the market price is more than 4,000, then I will pay you only 4,000.
Okay, sir. So that condition.
Contract terms. In that case, you have to follow the contract terms.
Yes, sir.
Once you sign the, once you agree to the, remember, offer and acceptance, once you have acceptance of
Yes, sir.
then you are bound by the contract. So once you have accepted the contract, then you are bound by those terms. So which means then on that day of the price fixing, when the market price, even if the market price is 7,000,
Yes, sir.
you will only
It
pay
will-
4,000, because that is what is there in the contract terms.
Yes, sir. Okay, sir.
Anybody else have questions? All right.
Yes, sir. Thank you, sir.
Okay. So maybe we can later on with Utsav and Siddharth, we can fix another time to make up some of the time we have lost today. All right. We will fix. You guys can fix a session. Maybe sometime in the evening we can fix another session. You can figure out well, we don't have either of them here today, but anyway, so we can do that later on. We can discuss that. I'll talk to them later on and get that done. Okay, guys, so you can, and then we will finish the class now. If there are no more questions, I'll just stop the recording.